afternoon. Thank you for joining us today for Journey Energy's year-end 2025 and their 2026 budget. Journey trades under the ticker symbol JOY on the TSX and JRNGF on the OTCQX. With us today from the company is President and CEO Alex Verge. There'll be an opportunity for questions after the presentation. Please enter them in the Q&A box. Thank you for taking the time today, Alex, and welcome.
Thank you very much, Jessica, and thanks, Adelaide, for hosting this webinar. I'm delighted to talk to everybody about our year-end results. We've recently updated our corporate presentation that you can find on our website. That's the basis of what we're going to talk about today. So I'll go through this and I'll hit some of the higher points. And as Jessica mentioned, please feel free to forward any questions. The theme of the company hasn't changed for the last little while. We are a small cap company, but we do have, unlike other small caps, we are different than most of the ones that you'll be looking at. We have a world-class Duvernay shale resource play, which is material in value to the company. We have an emerging power business, which we'll touch on. And then we have, a flagship property in Medicine Hat with an extremely large amount of upside with respect to polymer flooding and infill drilling. And then we have a stable, low decline asset base on which to grow. So we had a great year last year, and we are providing our guidance for this year, although we have a lot of challenges providing our guidance this year, partially because we are in a non-op position in a substantial joint venture. So most of our capital is being spent on the joint venture. So we'll talk about that. We'll talk about how we're spending capital. Our view is that we would like to expand our budget, and we do have an expanded budget. We've really started contemplating this in the last month and a half as commodity prices started to rocket upward, that, hey, we've got more cash flow potentially coming in than we were originally counting on. And if possible, we would like to perhaps drill more locations in the Duvernay than have been budgeted, or do a program on our own lands. And that would all be kind of later on in the second half of the year. Most of our budget is kind of weighted to the, I'll call it, second and third quarters. If we add anything, it'll probably be weighted to the new adds will be weighted to the fourth quarter. So it's more or less a back-end loaded budget. In the snapshot here, you can see our tax pools, and you can see that insiders have, since the fourth quarter of last year, been buying a considerable amount of stock and have updated their positions. In particular, Craig Hansen, our chairman, and myself. I've personally bought over 800,000 shares additional since the fourth quarter of 2024. If we move on to some of there's obviously a snapshot of where we're at. We're going to talk about the Duvernay. We're going to talk about power, but you can sort of see there, and we have central Alberta core area and a southern Alberta core area where most of our assets are located. You can see where the three power generation projects are located. One of them is right where our Gilby Duvernay is, and then you can see the location of Medicine Hat. These are our 2025 actuals. Key takeaway here is that despite having lower oil prices in 2025, and you can see that on the chart, we wound up reducing our debt by about 16%. We increased our funds flow by about 37%, and we basically reduced our operating costs. So we're gradually substituting lower netback barrels for higher netback, lower royalty, lower op cost barrels in the Duvernay. And as this continues, it will dramatically change the profile of our company. And we're augmenting this by, selling some assets that potentially are higher ARO and lower net back. And last year we sold $6.8 million of properties which had lower net backs associated with them.
How many non-cores would you have still to dispose of if you had to guess?
Well, again, that's a fairly open-ended question because arguably you could see selling, 2 to 3,000 barrels of production that you would consider non-core. So I'm going to just answer it this way. We're going to have a very different version of non-core. So we've got some really good properties. We've got some properties that have slightly higher ARO. A lot of these are kind of in our northern core area. But the key here is, and we're going to talk about this when we talk about net asset value in the next slide, is that a lot of our value is in a select group of properties. So this year, the bulk of our capital is going to go to just finishing off the power business, and then we're done with that for a while, and the Duvernay. So once we're done with that, if we go into next year, I would say again, the majority of our capital will be in the Duvernay. But to the extent that the Duvernay becomes self-funding, and we had originally thought it was going to become self-funding in 2027. If we drill it at a slightly lower pace, it might not come self-funding till 2028. But because of that, eventually the Duvernay is self-funding and we get more capital to pour back into our conventional assets. Most of that capital is going to go in 4 or 5 properties. So it's not really a question of core versus non-core for Journey. It's a question of, hey, we've got a bunch of properties here that most likely won't see any capital for 5 years. So all of those properties technically would kind of be up for grabs to take the money out of that and to put it in the higher return Duvernay. So that's why it's a tricky and an ongoing definition. And we would probably, sell properties on a one-off basis, but we'd also prefer to maybe sell out of a certain area or a chunk of properties as well. So we may look in the next few months at putting together and I wouldn't even call it a non-core divestment package, but a divestment package of a bunch of properties that we're looking at potentially selling, depending on what the market is looking like. I mean, with the market being as buoyant as it is, it might be really attractive to sell some properties in this market and then to take that capital and redeploy it into the Duvernay, which is, probably materially higher rate of return. So again, we have this sensitivity table. Obviously, it's important to consider where we're at. I mean, since February 28th, I'd say the world has probably changed. We do have some hedging. That hedging tends to kind of mute the near-term impact a little bit of the run-up in commodity prices. But again, what seems to be happening is commodity prices have run up, but the longer this goes on, the more likely that the tail has come up as well. So initially we saw the front end of the oil price curve come way up and the back end stay pretty constant. What we've been seeing in the last week is that the back end of the curve is starting to move higher. So maybe we have a situation here in North America where the back end of the curve comes up and we get some materially higher pricing. So we can talk about that when we talk about reserves and values in the next slide. But because of the uncertainty in our capital program, we provided an extremely large range for our guidance. So we basically added 15 million to the capital later on in the year, which will impact our exit rates, but it won't necessarily dramatically impact our averages. And then we have a base case capital program which we've put forward. So these sensitivities are more or less based kind of on the base case capital program, and you can see that obviously we have an extremely torquey commodity price move with respect to oil, almost $2 million per dollar of increase up to about the $80 range, and then it sort of comes down to about $1.5 million of increase per every dollar of WTI. And I mean, as we all know, we're at $95 WTI today, which is really off this, even off this chart. So we did release our year-end reserves on February the 23rd of this year. This is sort of a historical view of what that is. We've kind of added a couple things. We're going to talk about the Duvernay NAV and what we booked to the Duvernay NAV. But what you're seeing in here since 2023 is basically the Duvernay share of our net asset value going from almost zero to about 41% of the undeveloped net asset value. And by undeveloped, I mean this sort of red bar on this graph. So the black bar is our PDP reserves. The pink bar is the P plus P producing addition to that. So that's just basically a slightly lower decline. And all of the difference between that 1476 and the 517, all of that, that's about $9.60 odd cents or so, or 50 cents. All of that is our undeveloped wedge based on the capital that we booked in the Duvernay or in the reserve report. So if we take that $9.50 wedge and we kind of divide it up, about $4 of that is the Duvernay. Another $4 to $4.50 of it is 4 key properties, basically Medhat, Skiff, Matsuwan, probably Carrot Creek, and then our power business. Because our power business, we had only one small facility on, so the PDP or P plus P producing component of our power business is only about $5 million. But the GLJ cash flow runs on the power projects at the end of 2025 was $67 million. So a big chunk of that, close to $1 a share of that, is in that wedge. So essentially, if you get your head around 4 properties, the power business and the Duvernay, you've got about 80% of that wedge booked. And we'll talk about even the upside in the Duvernay and in Medhat beyond that booking, because there's a lot more still to come. So the difference between us and some of the other companies that people would look at is perhaps the credibility in our undeveloped wedge and the confidence that people should have in our ability to convert that undeveloped wedge to producing value in a relatively short period of time. So let's talk about the Duvernay. Let's talk about the changes this year in the Duvernay, what we've got booked. This just sort of sets up the orientation. You can see in here in sort of the peach color, a box in the middle of this map sheet. You can also see a very faint green line that moves along the edge of the map sheet. That green line is, in our view, our definition of where you go from high liquids to become progressively more gassy as you move further to the west. So that really, to us, defines the western edge of the oil window. So you can see that all of the joint venture assets, which are shown here in that peach color, are inside that oil window, or what we would call a low B sub O region of the Duvernay. So we have, with Spartan, we control about 113 sections in that 128 section block that is outlined there in the peach. It's a 30% working interest for Journey and a 70% working interest for Spartan Delta. Spartan Delta is the operator. If you look at the purple lines on that map, you can see all of the recent drilling. You can see some recent drilling just south of the joint venture by Spartan, just north of the joint venture by Spartan and Baytex, just to the west of the joint venture by Spartan, and then all of the drilling that we've done inside the joint venture. If you look at all of that, you've more or less proven up the entire joint venture with offsetting wells. So it really increases your confidence in our future development. So let's talk about our future development. Let's talk about our capital. Let's talk about what we have booked for this year. I'll start with kind of the map in the middle, which is basically our recent type curve, which was upgraded in the fall of 2024, and then it was updated again at the end of last year. So as far as this updated type curve goes, you can see 3 pads. Those 3 pads, I believe, are marked 1, 2, and 3 on that map sheet. You can see the relative performance of the 3 pads, 2 of them significantly outperforming the type curve and 1 of them kind of being on the type curve. Then you can see kind of an aggregated line on the bottom, a light gray line. Those are the original 3 wells that were drilled back in by Kowitno and came on in 2019. So you can see this step change improvement in performance of the new wells versus the 3 wells that were originally drilled. And you can see that we now have 9 new wells on production. This year, we are planning on drilling 8 wells and completing 9. So I'll take you to the number 2 marked on that map sheet on the left-hand side. That number 2 is the 6 of 4 pad. There are 4 wells that were going to be drilled on the 6 of 4 pad. Those wells, as of this morning, 1 last well, 3 of 18, we are running in the frac string. So 3 wells are drilled. The 4th well has been drilled, and we're finishing it off today. So we'll be moving the completions to those wells shortly. Those wells are scheduled to come on sometime in May. So that's 4 new wells coming on sometime in May. The number 4 is the other pad. There will be 4 wells drilled on that pad and 5 wells completed. The 5th well is that purple line there. That 5th well was drilled last year as part of the program, but hasn't been completed yet. So we basically will drill, 4 wells next to it and complete those 5 wells. Now, those 5 wells they're scheduled to begin drilling kind of beginning of May and to be completed and on in September. And the reason that has been delayed is because of that that red little plant that you see by the number 4 and that red pipeline that you see, which is basically gathering a lot of the existing Duvernay production, tying some of the existing pads up to that number 4, where Spartan is building a 30 million a day compressor station. So there's a compressor station being built right now at number 4, and then there's a gathering line. There's 2 lines there. There's a oil gathering line, which is an emulsion line, which is ultimately going to go all the way down towards that number 1. And there, all of the oil emulsion is going to be gathered, and then the gas, and then a large diameter gas pipeline. And that gas pipeline will connect all of the solution gas to the number 4, and the number 4 will connect that gas over to the Kiera area. So that's the plan. The lines that are planned for this year and the compressor station are about a $50 million gross expenditure. So that would be about $15 million net to Journey. There may be some more expenditures next year as we, look at trying to pipeline the oil from a central battery and build a large central battery and pipeline that oil. But those have not been kind of defined or budgeted yet. But right now we're in a phase where we're trying to set this play up so that we can essentially factory drill it for years to come and easily tie everything in and have the most economic and low cost egress that we can get with the maximum liquid yields coming out of the solution gas. So given all that, we have a type curve, and we're going to talk about building blocks using this type curve. So the type curve is the single well economics shown on the right-hand side of that sheet. Those economics are based on a $12 million drill complete equipment tie-in CapEx, and they're based on the black line on the map on the left-hand side. So we have an internal rate of return of 70% and a payout period of 1.5 years. What I will tell you is that the first 2 wells that probably are shown on that line in red, those wells paid out in under 1 year. So the new type curve is based on the GLJ economics at the end of last year. So based on 3 consultants' average pricing. So the thing that's interesting here is that year over year, we have dropped the pricing in the reserve report. So if we look back on, I've just got some statistics here on that. If we look back on last year's reserve report, over a 5-year period from 2026 to 2030, the price of WTI averaged $77.50 a barrel. If we look at what we have in this year's reserve report, and again, that was what that $14 per share number was based on, the average price in our reserve report from 2026 to 2030 is $68 a barrel. If we look at the price for 2026 in the reserve report, which is obviously the most important year from a discounting perspective, that's $59.92. Based on the way things started out this year and where we are now, I think we have a really good chance of beating that $59.92 for a WTI average price for this year. So I really do think the pricing in the reserve report is $68 a barrel average from 2026 to 2030 is relatively conservative, and you know that bodes well for future value creation or future value uplift based on rerunning things at kind of higher, longer term pricing if the conditions in the Middle East persist for any period of time. In any event, I think the prices used in the 2026 year are obviously too low.
So I'm going to ask just 2 questions, if
Sure.
you don't mind. Okay, so with the money that's going into the infrastructure this year, will there be more spend next year in infrastructure? And if not, how much could you see that bringing down your F&D costs?
Yeah, I mean, this is the challenge is if you're building infrastructure now that's going to last 10 or 15 years, you kind of have to push that capital over a longer period of time if you truly and objectively want to evaluate what you're spending in terms of F&D. So I think the best way to answer that question is this way. In terms of key performance metrics, we took a look just absolutely at the 7 wells that were drilled last year and what we received as bookings for those wells at the end of the year. So here's what I'll tell you. Of the 7 wells that we drilled last year, the F&D cost was $15.45 a barrel for those 7 wells actually booked in the reserve report. And the 90-day IP production costs was $12,350 per BOED. So that's what we actually physically achieved last year. If we look at our reserve report going out, for the Duvernay, the most recent Duvernay reserve report, basically our F&D cost in that reserve report is somewhere in the neighborhood of $15 a barrel. And that's for basically the drilling of 70 gross or 21 net wells. And the net back is, like I say, in that $47, $48, $49 a barrel range. So the recycle ratio on the Duvernay is, about 3.2 to 1. So I guess where I'm coming from is, as far as the Duvernay goes, net to Journey, we have 60 locations, call it $11 million each. That's $600 million of capital. And we may be talking about, an investment over the next 1 to 3 years of like 30 million of the 660 million on infrastructure. So, and some of that investment, most of that investment is already contemplated in the reserve report. So, I mean, there may be things like building a sales pipeline so that you can avoid trucking of sales oil. Well, if you're doing that, you're going to reduce the operating costs. So maybe the sales oil pipeline is in the reserve report, but the operating cost reduction is obviously not in the reserve report either. So making some investments into the future of the play to us does make a lot of sense. And I think it's difficult to judge something on a quarter or a half. You have to look at kind of where it's going over the longer term. Have I answered that question okay?
Yeah. That's what I wanted to hear. Yeah.
Okay, so again, like I say, the 2026 base Duvernay budget includes 35 million for the 8 wells and 9 completions that we're going to do that are outlined in the by 2 and 4 there on the map sheet. And then it includes about 15 million for that infrastructure, our 30% share of it that's shown in red. So, what we would like to see is, given the higher commodity prices, we would love to see, maybe more money, budget money being allocated to this and potential to drill another pad of 4 wells, and that would add another $15 million. And that's net to our share for those 4 wells. If we don't get another pad of 4 wells, we may consider taking that $15 million and doing a program in Medicine Hat or something in Skiff, doing something in our Southern Alberta properties as well. So at the end of the day, we're trying to figure out right now, how long is this sustained commodity price spike? How much more cash flow are we looking at? What can we do with that cash flow? We have expressed an interest to our partner to if there was an opportunity to drill more wells in the Duvernay this year, in addition to spending on the infrastructure, we would do it. So the next thing I want to talk about is, how is this changing our company? And really the next 2 slides will give you a really good idea why I would consider, even at the current valuation, that we're a pretty low risk investment. Like, we are basically trading at the produce out value of our assets right now. What you're missing is how this is going to change our company over time. So let's just talk about how good it really is. So in 2024, the Duvernay contributed 1% to our total production and about 2% of our net operating income. But last year it was 14% of our total production, and it was 32% of our net operating income. If we look at the chart on the right-hand side, it's a little bit tricky to explain this, but those are actual data points in gray. The ones in red are actual points. The ones in gray are points from our reserve report. What you can see here is that between now and 2030, we see the percentage of corporate production that is coming from the Duvernay to go from kind of that 14% last year to somewhere in the neighborhood of 50 to 60%. And you can sort of see that if it goes to 50 to 60%, you're going to see that, it's going to represent, 80% of our operating income. So when we look at our netback and everything else, we got to start looking at $45 to $50 netbacks versus the netbacks that we have right now. And again, all of these things are made at $68 a barrel average WTI for that 5-year period. So if we take the building block of all of these wells and we plug it into a development scenario, this slide is a really powerful slide because it tells you kind of what we're booking. It tells you what a development plan might look like. So what we have in this development plan is, again, it a lot depends on phasing as well. So what we have in this plan is we have the, obviously actuals up to the 2025. We have 12 wells planned for 2026, and they're all front end loaded. Now, I've just told you that, right now in the budget as a base case, we have 9 wells coming on in 2026, and they're not as front end loaded. So it'll look a little bit different than this. And then 2027 to 2030, we have 16 wells drilled per year. So the key here is that we ramp up to about 8,000 barrel a day peak, in 2030, 4 years from now or so. In this plan, we've drilled 83 gross, 24.9 net wells. We have identified, over 180 locations. So I'll talk about that as well. So we're only drilling about 40% of the plan. So what does that do for us? Well, again, like I say, $46.55 a BOE net back over that period, recycle ratio of 3.2 to 1, peak of 8,000 barrels a day. If you take the 8,000 barrel a day peak and you take the $46 net back, you can pretty much see that, that's a running cash flow of about, 130 million a year. And last year, we only cash flowed half of that with all of our assets. So you can see where that is coming from. Like the Duvernay is really going to be taking over in terms of our cash flow. And the interesting part of it is if you want to look at the value proposition, in 2023, it was 10 cents. At the end of last year, it was 482. And of that 482, the producing component was up to 87 cents a share. And the on the come portion was 395 a share. So what do we have in that plan? We had 12 wells that were on production, the 3 original wells, the 2 wells we drilled at the end of 24, the 7 wells that we drilled at the end of last year, 3.6 net. And then we had 70 wells, 21 net, undeveloped, that were part of that 395 per share in uptick in value. So when you add that up, that's about 82 wells. It compares very, very well to what you have on the chart to the left, which is basically 83 gross wells, and the other was 82. So 82 wells right there, based on the assumptions at the end of the year, $68 average price for a 5-year period, $59.90 this year. Those wells are worth $482 a share. Basically, it's telling you this plan is worth more than $482 a share on the left-hand side. But what's missing from all of this picture is that when that's all said and done, and we've added the $5 per share, and that's all PDP, and we've added the 130 million of cash flow, and that's part of our mix, we still have 104 locations, 31.2 net, remaining unbooked on our land base just to fill out the spacing units. And as I mentioned earlier, all of that is defined by existing wells. So that'll show you that really, if you get your head around the Duvernay, you get your head around the value of Journey, and you know that it's going up and to the right, and it's a compelling piece. We have some other things that we have that are unique to us that have value, will have value over time. Obviously our power business has been not without its challenges. We'll talk about the power pricing and the dynamics of it in the next slide, but just to show you right now, the Countess Power Project that we built in 2020 has been on stream. It's more than paid for itself. NPV value at the end of the year was 5.7 million at the end of last year for the Countess Power Project ongoing. The Gilby Power Project is something that we've been constructing, for the last few years. Where we're at now is Ford has had a little bit of a hiccup on startup. So they've been delayed a small amount. They had to replace a piece of equipment that shorted out, and they've replaced it, and now they're kind of testing right now. So we're really close on that. We've had 3 units there, a big one and 2 little ones. The 2 little ones have been running, and we've put power to a load bank. The big one has been fired up. It's been running. We haven't put power to the load bank yet on the big one, but we're close. Sometime in the next few weeks, if Fortis can test their back end, we should be discharging to the grid. So that's been a long time coming. And it's been a lot of capital investment that has seen, no return to this point. But starting basically, in the beginning of the second quarter this year, that thing is going to start, kicking out money and not consuming money. And the estimated value of that at the end of the year in the GLJ report was $32.2 million. The Mazeppa Power Project is in stage 5. I guess there is technically a stage 6, but stage 5 is the last stage that you're in before you finally, start it up. The Duvernay or the Gilby one has actually sort of passed through stage 5, and basically, as far as ISD dates is concerned, is from an ASO perspective, it's basically on. But Mazeppa is in stage 5. One of the kind of surprises we got this year, and that's not atypical of what we've seen, is that the original $1.5 million estimate for the grid connection costs was way too low. We had budgeted a higher number than that, but it came in at over $4 million, and we hadn't budgeted that high. But that's going to be a slight increase in our power expenditures for this year as we pay that. But we're hoping that, the ISD date on that has been moved out to kind of November of this year from the summer of this year. Maybe we can get that on before that, but we're still, obviously we're hoping that we get that on at the end of this year for sure. Last year, at the end of the year, we started inspecting all of the engines. Basically, because we weren't even in stage 5, it didn't make much sense to do anything. It just sat there for all those years while we were trying to get to where it is. Once we kind of moved into stage 5, now we've got the grid estimate. Now we know what Fortis needs to do. Now we're all moving together. We did have the ATCO line run to the plant. We've now got gas to those units. We can actually start running the units. We've been working on the gearboxes. So we're just, and we also have to update some of the controls because they haven't run for 7 years, and there's updates to the controls. So we're probably going to update those. So we're basically going to be in this sort of spending phase. We haven't spent much on that other than the original purchase, but we're going to be in the spending phase of that this year. GLJ estimated the present value of that to be about $37 million a year dollars at the end of the year. So, basically GLJ has estimated the power business to be worth about $67 million. There's virtually nothing in our share price for the power business. It's taken a long time. Power business is challenging in Alberta right now. We'll talk about that in the next slide. So, but the key here is that 85% of that money or 90% of that money has been spent. So essentially, we've been paying, and now we're going to have an asset, and it's just sitting there, and it has value, and it'll be shown to have even more value over time as power prices fix themselves. The question is sort of, when is that going to happen? Most experts called this recent downturn in commodity prices or power prices back in 2022. They said, from 2024 and beyond, power prices are going to be low for a few years because you've got a lot of new capacity coming on. And that is what ultimately materialized. You can see there the historical average power cost for the last 25 years has been about $68. Since 2023, we've been kind of lower than that. So lower than the historical average over the past 25 years, but clearly we're forecasting demand for power in Alberta to double by 2050. So this market is going to change because I think what we have now is we have a lot of renewables and a lot of cogen, with respect to waste heat from the oil sands. I don't think oil sands waste heat is going to double. I don't think a lot of renewable projects are incremental or moving ahead. So you're really looking at a lot more reciprocating natural gas and turbine-based natural gas projects coming on between now and 2050. Don't know how many of them are going to be connected to the grid, but I do feel pretty strongly that this is a 20-year project, and we do feel that, power prices are going to increase. So if we go back to the historical average of sort of 6 to 7 cents, and natural gas prices in the 2 to 250 range, you're kind of looking at about 10 million a year of cash flow from the 30 megawatts that we'll have on kind of by the end of this year. That is a number that should just go up and down maybe with power prices, but in general, the weird part about oil and gas assets is obviously you have natural declines and you have to invest. Here we'll have to do maintenance, but we should have no natural declines in our power output. So as long as power prices move up and to the right, starting in kind of 2027 and onward, these will become much more valuable over time. And there, I think we'll receive all of the value that we paid for these things and more. But I think it just, we need a recovery in power prices.
Do you consider selling the power business, or do you want to keep it as part of the company?
The reason we would keep it as part of the company is primarily because as a producer with a lot of kind of assets under secondary recovery, like the reason we have a very low decline is because we have a lot of oil weighted assets in large pools that are on secondary recovery with water flood, in the case of Met Hat water flood and polymer flood, which basically gives you a long decline, a slow decline along RLI, but it does have a lot of moving parts. So in other words, we use a lot of power for a BOE that we produce. Now the Duvernay will be different than that, but because of our existing conventional base, we do use a lot of power. So originally we got into this business because in 2020, our power bill was under $5 million a year. In 2022, our power bill is $23 million a year. So we designed this business so we would get about the same amount of cash flow from the power that we spent on buying the power. So just to put this in perspective, in 2022, I believe the power was about 13 cents. So if we go into that sensitivity chart and we look kind of at 13 cents, you can see that these things, at $2 gas or $2.50 gas have over 20 million a year in cash flow coming in. So, inevitably you're going to sell this thing right now at a generational low in power pricing, and 2 years from now power is going to be 15 cents a kilowatt, and you could have been cash flowing $25 million and you didn't receive that value for it today. So one reason to keep it. The reason to sell it would be because clearly any money that you generate and spend on the Duvernay is an uptick. So it's more of a, hey, let's live for today and sell it. But I think the reality is that these projects have the potential to become more valuable over time. And I do not think you're going to get the right value for them today. You'll get a much higher value for them in an improving power price environment if they're connected to the grid and already producing. So because we are so close to producing with Mazeppa, and because Gilby's essentially on right now, be nice to let them run, for 6 to 12 months before you would consider the decision to sell them. So I think, if we could have sold one a few years back or early last year and used the money to fund the Duvernay, we might have done that. This year, I think probably leaning on keeping them and then looking at selling some of our other non-core assets that we don't see getting capital. Like, we don't see this power business getting capital over the next 5 years, but it doesn't need any. Whereas the non-core assets are declining assets and they need capital to maintain low operating costs and to maintain value. And if you don't see yourself spending any money on those assets, they're better off in the hands of somebody else. So Met Hat is an asset that we can just talk about briefly now because, that is an asset that will see capital. So as soon as the Duvernay is either self-funding, or if we don't do an extended Duvernay program and we do a bigger program on our own assets later on this year, Medhat will get some of it. So we've drilled 8 wells in Medhat since we bought it. Here's some interesting facts that we put on this slide here. You can sort of see the uptick in production. You can see what a great decline profile it has. But the thing is here is that, it's got a multi-year inventory. It's got 34 locations that are identified. Only 19 of those locations are booked. Of the 19 locations that are booked, they're worth 60 cents a share. So if we look at drilling all 34, that's probably worth $1 a share. And then we've also got a huge polymer upside wedge, which isn't booked. But since we acquired this thing in the fall of 2022, it's generated $62 million of income, and 45 million of that is free cash flow. So that shows you the value. Everyone says, oh, maybe you should sell Medhat to fund the Duvernay. And the point here is that it requires so little money to maintain it and so little free cash flow. And over the next 10 years, especially with infill drilling and polymer upside, it will free up so much free cash flow that you will never get someone today to pay you the amount of free cash flow that's going to be coming off of this asset over the next 10 years. So your best bet is just to keep it, take the money that's coming off of this, that's free cash flow, and pumping that free cash flow into the Duvernay. And that's how you're really going to get your maximum value out of this flagship asset. So as far as the polymer goes, we have a polymer blending facility in the north and in the south. These facilities were built in 2015. They were built at a cost of about $30 million. Today, that would cost materially more than that to build these things. It means it's really easy to expand the polymer flood. Now, you have to pay for the polymer, and we pay, $3 million a year in capital for the polymer every year and inject it. But you have to pay for the incremental polymer. And this expansion will, you need longer periods of time. Like you need to convert a few wells to polymer, maximize your blending facility. Once those wells are kind of played out, then you need to convert more wells. So, this is something that's going to play out over 50 years. But when you look at the chart on the top and you look at the top of that arrow, the top of that arrow sort of shows you potentially being able to maintain this thing at about 1,500 barrels a day or more for, till 2050. So essentially, through the infill drilling and through the polymer expansion, you're going to be able to cost effectively keep this thing flat for many, many years, freeing up a lot of free cash flow, which you can do in the Duvernay. And that chart in the bottom is just a chart that shows you one of the wells or one of the areas that we've converted to polymer flood. And you could see how, you drill it and it's 150 barrels a day and it's dropped all the way off to 50 barrels a day. And then we've converted the offsetting injector to polymer flooding and off it's gone back up to kind of that original rate. So, it came on at 160 barrels a day, naturally declined to 45. And then when we did the offsetting polymer injection in mid-2025, you can see that we've already got that substantial response. So the polymer works, and it's been proven to work, and it's cost effective to expand it. So when you look at what it does for us, under water flood, the recoveries average about 16%. Under polymer flood, we're getting about 28%. So that incremental recovery is 12%. The reservoir itself, basically, when we look at the patterns that have been flooded, only about 20% of the pool has been flooded right now. And there's about another portion, maybe 20% of the pool that will never be flooded because it's on the other side of the river and it's more difficult to access or just not going to make sense. But there's 160 million barrels of oil in place that is yet to be flooded under polymer flood. And like I say, this is going to take years and years and years to do, but if you take 160 million barrels of oil in place times a 12% incremental recovery factor times 72% working interest, that's another 10 million barrels net to Journey at $1 to $2 a barrel that can basically, be part of your bright future. So, it really is a flagship asset for us. So now with kind of this and the power and the Duvernay, we pretty much talked about all of our, significant future upside. We have lots of upside in Skiff, Carrot Creek, some other properties as well. But I mean, we've talked about the big sources of value creation coming. So in our reserve report summarizing the end of the year, we have basically a development wedge. You can see with the pie charts on the bottom, you can see like last year, you will see that we probably had only booked about 20% of the Duvernay locations. This year, that's up to about 40% of the locations are booked. You can see under the booked projects how much of our future inventory is the Duvernay. Really, it's now more than half of our future inventory, and it's even more than half of our unbooked inventory. Kind of an important thing that we like to look at is if you take your future development capital, $524 million at the end of 2025, and you take the value uplift you get from that future capital, for every dollar of future capital we spend in our reserve report, we get $1.17 of net present value. Again, this is all at that $68 pricing for the 2026 to 2030 time period. So, I mean, you can compare that to other players in the area, and what you'll find is that that's a good number. That's a high value add for the future capital. A lot of guys spend $1 in their reserve report and they only get 50 cents of value uplift. So good projects booked in the reserve report. Again, most of them in 4 or 5 key pools. As we go further on this, what we're doing is we're actually cutting out projects in areas where we don't see capital going in it for 5 years. So we do have projects in some of these non-core areas or some of these other areas that what I would call sort of second tier areas for us. But because we're not going to spend money, we're gradually moving them out, moving more Duvernay projects in. So the future capital is going up, but actually the capital in the reserve report is actually getting high graded. So the amount of capital dedicated to those few properties that we have really good results on is pretty well defined. So you can see here, I mean, these are our play economics for the different types of plays. I mean, you can pretty much see that the Duvernay wins on payout, the Duvernay wins on rate of return. So anytime you can shift capital from other areas to the Duvernay, I think you're improving your business. So, our future is really headed in that direction, and it's really crucial for us. Again, so what we're going to continue to do with the non-core assets is basically divest these assets. Over time, if we look at a summary of last year, we divested 788 BOEs of low netback assets. So we maintained our production, but we divested assets. So at the end of the day, we wound up shedding some ARO, replacing that higher cost, higher gas weighted production with higher ARO, replacing that with higher netback Duvernay production. And that's why, operating costs look good, royalties look good, and everything else looks good. So, I mean, that's a pretty long trip through the presentation. I do have a slide in here that just shows, how much, and this is not Duvernay. The Duvernay is going to kind of double us up again, but this is a slide showing, how much oil we have in our conventional assets. We've got a billion barrels of oil in place. If we can just get a couple % more recovery from that, higher the commodity price goes, the more things that are feasible to do in our other assets. So that's another kind of exciting thing. We're sitting on a big base of resource, and if you give us higher pricing, we're going to have more economic projects to do. That's just what you're going to see. And in the appendix, there's a picture of our Gilby Duvernay power project right now. In the appendix, you have our year-end reserve numbers here, just a summary of what we have. The thing that I'll just conclude on here, the 16 million barrels of PDP oil in place, 20 million barrels if you include the probable producing. Now, this year, that does include some Duvernay because we do have more Duvernay wells drilled. But when you look at it, where does that 20 go? So 20 million is what we have on right now. 43 is our proven plus probable. So that's the additional adds. On top of that, you've got another 15 million barrels you can add from the Duvernay that isn't booked. You've got another 10 million barrels you can add from polymer flooding in Medhat. So you've got a company that has a proven producing value or a proven plus probable producing value, which is close to their existing trading value. So our 2P DP value today is 517 a share. It's pretty close to where we're trading. We're going to triple that producing oil over the next, 10 to 20 years, just with the projects that we have identified right now. So, I mean, there's a lot more on the come. It's all real. It's all very easily definable. And that's what makes us different than our peers. So with that,
So you've answered almost all of my questions, Alex.
I don't know if you received any more questions. I mean, I took most of the time, so I get it.
No, just I want to ask you, hedging, you said you had some on. Are you doing any more, or are you just hanging tight with seeing what
Oh,
happens with
sorry.
oil?
Yeah, there is a slide in the corporate presentation. It's in the appendix on the hedging. We do have quite a bit of hedging done. It is because we have a bank line, we put a line in with National Bank last year. As part of that, we do have a certain requirement to hedge. We have been hedging, recently, but also before the war. So if I look at, this quarter, we've got about 3,000 barrels a day hedged out of the sort of 6,000 plus that we're producing. So close to 50% kind of hedged. But, the ceiling is, in the $80 range on that for WTI. So it's a wider collar, $50 floor and $80 ceiling. So, pretty good this, quarter. Obviously didn't need it in the first 2 months of the year. We're kind of right in the middle of everything. But, this quarter, like this month, I mean, right now we're averaging kind of $87, $88. We may average kind of, 90 to $95 for WTI this month. And, this month we've got 3,000 barrel hedged at 80. We do have about another 3,000 barrels hedged in the second quarter. Again, $72 ceiling. If prices stay at $95 for the entire second quarter, we're obviously going to lose. We're going to benefit because, you've got 3,000 unhedged barrels, but you're going to lose some money on your hedges. But I mean, if prices stay at $95 a barrel for the entire second quarter, then what is that your third, fourth quarter, and all of next year is going to be like way better because obviously the supply disruptions are continuing and you've burned through all the inventory and you've got some major issues. So, then that drops down to about 2,000 barrels a day in the third quarter. So the third quarter is kind of our charm because the hedging is dropping down as the new Duvernay wells are coming on. And then in the fourth quarter, we've only hedged 1,500 barrels. So, as we put on hedges now, into the third quarter, fourth quarter, into next year, we're going to be putting them on kind of in this newer price environment. But I do want to, make everybody aware that, you've got a steeply backwardating curve. So you may have $95 WTI today, but in 2037 on the strip, it's $60 or less. So you can't hedge $90 for any period today. In fact, if we're close to $100 WTI today, there's almost a $60 or $70 spread between WTI today and the price in the Middle East. So, you're $150 in the Middle East today plus on a barrel of oil, $98 or $96 WTI. But if you look at the pricing that you can hedge for, you can't even hedge for $85 a barrel in the third quarter. So,
Yeah.
and in the fourth quarter, you can barely hedge for $75 a barrel. So, and next year you can hedge for like $65 a barrel. So at the end of the day, as you move further out with your hedging, that's just the nature of the business that we've been in the last few years, but it's way exacerbated by this crisis, is that the entire strip is extremely backwardated. So the front end of the curve has moved quite a bit, but the back end hasn't really moved that much. What we're starting to see now is, as this extends and extends and extends, every single week that goes by with more production offline, the back end of the curve will slightly start to go up. So that's why, the stocks haven't really moved as much as they could have moved. Why? Well, because the back end of the curve isn't really going up, and everyone thinks that this is a short-term supply blip. Over the last week, people are starting to say, well, maybe it's not short-term, maybe it could maybe even be medium-term. So now you're starting to see the stocks starting to move up, all of them, everything, because now they're saying, okay, well, you know what? It's going to take a while to work this off. And if you've depleted all of your, strategic reserves in all of these countries, and you still have a problem, and you still have a supply glut, prices are going to move up, and the duration of this thing is going to move out. And as that happens, the back end of the curve will start to move up, and then you'll start to get some better hedging in place for the future. But right now, it's a pretty backwardated curve.
Yeah, definitely. And like you say, the physical market's $150 a barrel. So why would you really be
Well, you don't
putting
want to
up?
hedge anything at all, but you also want a bank line. So,
And you're protected, yeah, for your bank line. So and your capex.
yeah.
So anyway, what? Okay, I'm just gonna ask one question. If in a year, what do you think? Which metric will have improved the most on your story?
I personally tend to focus on things that I can control. So I don't feel that we can control whether or not we're going to be selling assets or not. So I don't want to, focus in on kind of arrow or other kinds of improvements. I mean, what I know we're going to do is we're going to bring on 9 new Duvernay wells as a minimum and possibly more. I know we're going to bring on the power facilities. So what I do know is that our netback per BOE is going to improve because the Duvernay and power will be a larger component of our funds flow, and that's coming in at lower operating cost, and that's coming in at lower royalty, and higher liquid rating, and so I would say that the one thing that Journey has been missing, and we've been working on this for a long time. So from 2020, I mean, we as a company are long net asset value. We're long value. We've got long life, low decline assets that are worth a lot and aren't declining. But we have been trading at a discount because we are short on cash flow.
Oh,
So what the Duvernay does is it does the exact opposite. It is maybe shorter on net asset value growth, but way, way better on cash flow growth. So what the Duvernay will do is complement our existing base dramatically. And so, our net asset value will grow a little bit, but our cash flow will go through the roof. So if you look out in the future and you say, what metric is likely to improve the most? Well, the metric that is likely to improve the most is our netback as we, put more Duvernay production on. That is the part that's going to improve the most. And, if we manage to rationalize some non-core assets, and if those assets have a lower netback and have a higher ARO, boy, that will push the netback even higher faster. So that would be an additive thing to this rather than something to take away. But if we just focus on the things that we can control, our netback is going to improve, much more dramatically. And that's, I mean, obviously that's especially true if we average more. Like when we entered this year, we were fully aware and fully planning for the price of oil this year to be lower than the price of oil was last year, just based on the forward strip and based on the narrative around tighter, oversupply over the first half of the year, maybe a little bit tighter in the second half. So, I mean, we were fully prepared to have lower netbacks this year. But now I look at it, I go, not only are we going to have more Duvernay production, but we're going to have more Duvernay production and we're going to have potentially materially higher prices. Definitely higher prices, I think, but potentially materially higher prices. And that's obviously going to drive the cash flow and netback way up there.
Awesome. Well, it was a very fulsome overview. And like I said, I had 3 pages of questions, but you answered them all. So good job. Good job. And I don't think anyone from the audience had any. So that's great. And we look forward to your well results coming soon and keeping up on that. And thanks again for your time.
Thank you, Adelaide. And thank you, Jessica. Thanks for everything. Thanks for everything you do for us all the time.
Okay. Thank you.
Take care, everybody.
Bye.